Absolutely. Well, I'll be the first to say that I know this is a pretty popular phrase, but your net worth is your network in
Hmm.
real estate. It's not necessarily about what you know, it's who you know. You have to be getting that first call as a GP or as a potential investor. You have to have some kind of in my opinion, asymmetric competitive advantage on the sourcing side. Some reason that you're getting the call over somebody.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
Today's guest is just a wealth of knowledge, and this knowledge has come from years of experience, a wealth of experience. And we're going to run through this stuff, starting out in the world of finance, moving into working with hedge funds directly into a bigger hedge fund, and then leveraging those relationships built during that time and stepping off into his own investment portfolios. You're going to love the conversations here, built around Redwood Capital Advisors. And wow, just the ranging from the diversity in the asset class, a casino in Biloxi, Mississippi, medical buildings, luxury RV parks. You are going to love this conversation. Everybody, please welcome Mr. Ben Spiegel to the show. Ben, how is it going today, man?
Not bad. Usual day in the life of a real estate syndicator, I guess.
Oh, yeah, absolutely. And we were talking just before we started recording here. You're bouncing back and forth a little all over the place and got some active deals rolling around. And you just got back from Mississippi, huh?
Yeah. So one thing about my strategy that I think is a little bit unique is I like to call myself asset-agnostic. I don't have one particular focus on one certain asset class. I try to focus more on what I like to call special situations, whether it's medical office or multifamily or even luxury RV parks, which is what I'm most bullish on right now in the Southeast. So that's what I was doing in Mississippi.
Very cool. Very cool. And this is the Real Estate Mogul MD. A lot of the guests that we have on, a lot of listeners are physicians, but the two of us are not. So let's just start there and see, give us a little bit of background of where you came from and what you're up to now.
Yeah, so when I graduated college in 2011, Syracuse, I went to Barclays. I started investment banking for about a year, and then I was tenacious enough to network to my way to the buy side. I got a job at a hedge fund, a small credit opportunities hedge fund. Was there for another couple of years, and then I moved to a larger hedge fund, and that's where in hindsight, was smart enough to listen to some friends and started taking some of my bonus money and buying pieces of small buildings with them.
Yeah.
Usually like a 3 or 4 unit in like a working class neighborhood, something that wasn't too management intensive. Back when things were trading at like 40, 50 grand a unit. But that's how I got my start. And after a period of doing that for about 4 or 5 years, I got a call from one of my main lenders that they had a much larger deal, non-performing loan, cross-collateralized by a lot of apartments. And basically, long story short, I decided to leave the hedge fund I was at, buy the note, take out note-on-note financing, and raise some equity and start doing this full time. That was back in 2017.
Very cool. So a lot of stuff happening in there. That note on note financing, very interesting. So you purchased the non-performing note. What? Just jumping back in
Yeah, of
on that.
course.
So
Sorry, I probably
you
went a
used
little
the note
fast. Yeah.
to purchase another non-performing note, and then what happened with that particular deal? Did you end up foreclosing on it, or did you buy that, or?
Yeah, so basically, the banks never actually want to own the assets that they lend against.
Right.
So especially if they could sell the debt at par or 100 cents on the dollar, they will happily get rid of it. And then it's up to the buyer to take it through the bankruptcy process, which does take 8 to 12 months. It's not, it's expensive, it's tedious, there's a lot of legal fees, a lot of court appearances. The owner at that point doesn't want to give them away so easily. But what investors try to do in that situation is to not to limit their equity raise, their cash equity raise, is they're able to go to a bridge lender or a private money lender and get something called note on note financing, which is basically just debt secured by the note, which has a lien on those buildings. So
Mhm.
note on note financing, usually you can get about like a 60%, 66% loan to the value for what the note is.
Interesting. Very, very interesting. Lots of stuff there. But moving, I think another piece of that I hear, Ben, is like the relationships. I love that direction of coming through the finance and baking into the hedge fund world and really, hands on every single day, seeing these bigger opportunities and how they're structured, what types of relationships they are. What are the returns? How are they being underwritten? How are they being collateralized?
Absolutely. Well, I'll be the first to say that I know this is a pretty popular phrase, but your net worth is your network in
Hmm.
real estate. It's not necessarily about what you know, it's who you know. You have to be getting that first call as a GP or as a potential investor. You have to have some kind of in my opinion, asymmetric competitive advantage on the sourcing side. Some reason that you're getting the call over somebody else, and that's usually that you offer certainty of close. And like you said, I came from investing in middle market, special distressed, and bankruptcies on the credit side. So high yield bonds, leverage loans, and you would see these investment banks like Credit Suisse and Deutsche Bank. They're because of some crazy rules, they're basically allowed to underwrite companies' earnings however they want. Like it would be called, like in terms of real estate, it would be the equivalent of like underwriting a building with 0% vacancy and zero property management and zero repairs and maintenance.
Hmm.
This artificially increasing earnings to make them to dress them up to make, and that's called adjusted EBITDA. But or just that's what they do. So I already had a lot of experience with kind of not being trying to be misled before I got into the real estate business.
Wow, wow, that's crazy. And then I don't get too far down this road, but those loans that you were just talking about there, were those backed by the government then too?
No, so these
No.
were term loans and high yield
Right.
bonds that were basically underwritten by investment banks and then sold to private lenders, hedge funds, cross collateralized obligations, business development corporations, and basically used by private equity firms just to continue monetizing the companies that they own, whether it's an LB leverage buyout or a dividend recap. And then the interesting thing, though, is that they're semi-liquid. They trade in the secondary market, but only via phone. And no, it's not electronic. So there's a lot of inefficiency there.
Wow.
And that's really what gave me a lot of the guiding principles that I take to the real estate business in terms of really always trying to look in terms of being a contrarian, always looking where nobody else is. I mean, who's going to Mississippi?
Right.
You're
Right.
just always trying to not be against the herd or just try to be just do something different, because if you go along with whatever the popular thing is, you're never going to make an outsized return, in my opinion.
Hmm. Yeah.
And I just like for what I would say for uh, your guests watching the show is in terms of when they're analyzing general partners to or sponsors to invest with, especially in the market we're in today. I mean, when the past 5 years, when you could borrow at 3% interest rate and 80% LTV, and it doesn't, on anything, it's a rising tide lifts all boats. It was very easy to make money.
Mhm.
But now with interest rates at 7% and even being difficult to get a 60% LTV loan, making money has gotten a lot more difficult. So I would say really be careful and only invest in what I would call a special situation, some reason that the asset that they are targeting, they have a competitive advantage and they're getting it for a ridiculously cheap valuation. And they have a clear, defined path to bridge that valuation gap that you just can't rely on. We're going to renovate the apartments a little bit and raise the rents, and that's how we're going to make our money. I believe those days are kind of gone.
Mhm. Yeah, yeah, definitely interesting. And two massive pieces in there too is taxes and insurance. Insurance is I
Up 20%, 15, 20%
man,
a year.
insurance. Oh, that's a whole nother world. But that, again, is coming down to just like banking. There's the investment side of it. There's a reason they do what they do and at the volume that they do it at. And the same thing with the insurance. But how can we? I mean, you've got so much experience and it's absolutely remarkable. RedwoodCapitalAdvisors.com to look at the team as well as the portfolio. And I love the diversity in the assets too. Like we're talking uh, the casino in what right there near Biloxi,
Biloxi,
right? And then how
mobile
you
home
were
parks,
a
medical
piece of that.
offices.
Yeah. So it wasn't like you bought the casino or a general partner, is it? It's almost like you invested in the funding, the construction piece of that, right?
Yeah, it was a unique transaction where it was actually a relationship carryover from my hedge fund days. I was able to invest in something called a unitranche loan, where it was a hybrid debt equity structure, where it was a bridge loan that had some equity warrants attached to it at a certain strike price, which was triggered by operating performance once the casino actually opened.
Interesting. And then this deal is in your past investments, so you've cashed out of that one completely in 2019?
Yep.
Interesting,
That,
interesting.
yeah, that was back. It was a short hold. It was only like three or 3.5 year
Mhm.
investment. But uh, right now, I believe the most attractive opportunity, like in real estate in general, is either mobile home parks, or if you can find the right operator and the right asset manager, RV luxury RV destinations. I mean, just to
Interesting.
kind of throw out some numbers that really nobody's aware of is, I mean, the average age of an RV owner in the United States now is 32 years old.
Oh, wow.
So last year in 2022, 450,000 new RVs were sold, but only 15,000 new pads were built. So less than 3% of some new supply coming in. And the average age of existing RV destinations is 40 plus years. So,
Wow.
and they're all owned, 95% are owned by mom and pops and
Oh,
they
wow.
don't even offer internet or cell phone service.
Wow.
And then let's say one last thing, what really just is mind blowing and kind of brings it full circle is post COVID, 60% of office workers are now permanently remote.
Mm-hmm. Mm-hmm. Who
So
can work out of a mobile or a
it's an RV park.
motorhome? Yeah, RV. Yeah.
I mean,
Interesting.
it's not a 62-year-old middle class retiree. It's a 33-year-old IT guy with 4 computer screens working out of an RV.
Mm-hmm.
It's
Yeah, those numbers are crazy. And for the listeners that I can't see that, I sat up in my chair as you started walking through that because my mind like putting together the pieces like, oh man, there's definitely a need and a change. And I saw something earlier today. It's like being able to notice trends via numbers like that, and then being able to predict them and then use them. And that's exactly what it sounds like you're doing. That's awesome.
Yeah, it's forecasting. It's real. I put a lot of emphasis on statistical analysis and really doing robust underwriting. And before I pick a location, like it's not on my website, but I currently have multiple sites under construction right now in Louisiana and Alabama because my research indicated that Florida and Texas were already semi-saturated with these
Hmm.
destinations, but Louisiana and Mississippi and Alabama had a rather remarkable lack of institutional presence. So that's where
Interesting.
I chose to make my foothold, and basically because there's a huge population migration, a huge wealth migration, and it really comes down to two simple things. The Southeast has two things that nowhere else in the country has. It has power and water. You can't build a factory in most states anymore because there's just not enough water. So it's
Hmm.
stemming growth. So there's just a huge rush of construction, of money. Just the Southeast is going to be a boom for the next 10 plus years at least.
Nice.
And, basically with the rise of glamping and outdoor hospitality in general, it's my opinion that in the next 4 to 6 years, the vast majority of the industry will be acquired by the Hiltons and the Marriotts, and they will own the outdoor hospitality industry.
Interesting. So they're going to move. You feel that they're going to move to these parks,
I mean, it's not an if, it's when, because
right?
the cost of a traditional vacation is just getting unfathomable.
Hmm.
For plane and hotel versus being able to just put your kids in the back of an RV, get the dog in, throw your bags in, and just go. It's 1/10 the price. And
Hmm.
if there's destinations out there that are pretty much like luxury resorts, but without the actual building itself, people are going to be more and more inclined to do that.
Yeah. Very interesting too. The change in that away from like the Hilton and Marriott and stuff is this Airbnb, and I see on your portfolio you also have something in Southampton. That's a
Yeah.
luxury Airbnb. Tell us a little bit about that. The mainstay.
Yeah, so I have a joint venture partnership with some guys that operate some luxury Airbnbs throughout the Northeast. And basically, like I said, I'm asset agnostic. If there's a market for, if so, we were able to get that for very cheap. So we paid 1.85 million. It was a woman and her owner operator of a B and B. So just to have anything zoned, not as an actual bed and breakfast, it's zoned legally as a bed and breakfast. So it can be operated as both a vacation rental and a bed and breakfast. Like during the winter when the demand's down, you rent it out by the room, and you have a chef on the bottom, and it makes good money. But basically, it was a woman in her late 70s that had owned it all her life, and it's just nobody really wanted it because it wasn't big enough for an institution to buy. Yet it was kind of and with high net worth guys, it was too much work for them. So it took a
Hmm.
very unique kind of buyer. So we were able to pick it up for about 1.8 million, and then we put about another $1 million into it. And I recently appraised, or about a year ago, it appraised for about 4.5 million bucks,
Oh
and
wow.
it throws off about 150,000 in free cash flow a year versus a total equity investment of 800,000.
Wow.
So it's a very solid investment, and but the Hamptons they go up and down. The price rental Airbnbs go up, and so sometimes revenue will fluctuate 15-20%, but our cost basis is just so low that it doesn't really even matter.
Hmm. Interesting.
And that's what I mean. You have to buy right. Like if when you're investing with a sponsor, wherever, it has to be a weird, one-off, unique situation where you're getting just an unfairly competitive, an unfair price on the asset to make it worthwhile. And
Hmm.
that's why I say I'm asset agnostic, because you can't afford to just focus on multi or medical or Airbnbs for that matter. I mean, you have to be a strong enough analyst to be able to really underwrite a myriad of situations to be able to keep a robust enough deal pipeline to keep yourself busy.
And could you give any advice to the listeners and your experience in the medical piece? A lot of the physicians are going to have their own practices. They're going to, either be renting space or considering developing space. Tell us a
It's
little bit
funny you
about
say
your
that because
experience there.
I'm in contract on a 40,000 square foot medical office right now. I went into contract yesterday on it. I
Hmm.
love medical right now. It's Medical is it's the office. It's the only office kind of office that's attractive because just with the aging population and a myriad of other trends, is things. A lot of practices are leaving hospitals. A lot of services. It's just too expensive to run them in hospitals, so they're moving out and they're moving to medical offices. So I feel that there's just the doctors know way more than me about any of this. And I know what I read and I know what I see in my buildings, but I'm bullish on medical offices. And if I was a doctor, I would try to, you know, I was in an office and I did a good analysis. I would try to work out a deal with the owner, maybe get some seller financing. And if your practice could support buying it, I would definitely look into that. If it has enough parking and you can get a good decent cap rate on it, and as well as decent financing. There's a lot of factors, but if the numbers work, absolutely do it. Better than just putting it in an IRA.
Yeah, yeah. So start in the room you're in. If there are a physician out there listening, thinking, if you're renting space, hey, what would this look like if I could acquire this? And that seller finance piece is huge. Making that, depending on who the property owner is a great place to start. And how about any experience with the new construction piece of that? Like if there are any listeners out there considering developing either in a strip or the emergency medical type scenario, the pieces that are coming out of these hospitals, and you need to develop a structure for that. Do you have any suggestions on that?
Yeah, so if you're going to develop, it's not so easy because they're just between the zoning restrictions and I mean, like concrete is up 3x in the past 2 years. Material. So, but if you have a special situation where it does make sense, go modular. Modular technology has really just exponentially grown in terms of feasibility and ease of it will cut your construction time in half
Mhm.
by going modular. And they do modular office, they do modular everything now. So definitely do modular and always hire a local architect that is going in front of the planning board at least once a month and knows everyone on that board very well. Hire a local civil engineer. Just make sure you hire everyone local that are people that are well liked and that have more of like a pat on the back relationship with the right people, because at the end of the day, that's what's going to push your project through faster and get your inspection on the books a little, a couple of weeks before the other guy, and those weeks make a big difference. So I've done a few ground up new developments, as well as, I mean, I'm talking like complete gut renos, like where like the only thing standing, like down to the studs, like
Mhm.
which and I mean, they take over a year sometimes. It's with interest rates where they are, it's a little bit difficult. But what you're seeing finally now is with the rise in interest rates is finally the general contractors are not so busy. So they're starting to call you saying, "Hey, you got any work for me?" So their prices are going down a little bit. And
Interesting.
if you're able to get a good price on a piece of land and you have a good plan in place, go for it. As long as you can get the financing element.
I
I'm
love
happy.
that.
I'd be happy to talk to anybody about if they want to, book a time on my calendar, looking for any advice or to put a little bit of a business plan on the back of the envelope. I'd be happy to walk you through it.
That's awesome. That's awesome. And they can connect with you at Redwood Capital Advisors, RedwoodCapital Advisors, ADVISORS. When we make
Yeah,
these dot coms, how many
I
times?
probably should have. I probably
I know,
should have
right?
chose a different name for a website. Maybe like
And this probably your email is
RCA.LLC.
probably like that too. And it's like, I've got, a couple of URLs, and when you're creating them, it's like, oh, I want it to say this and I want it to be that. And about 3 years into writing your email address, you're like, man, come on with it already. you know?
I mean, I'm at the point where I'm probably gonna have to just like create one of those like sub email, and then that just
Yeah.
connects to because it's getting ridiculous at
Yeah.
this point. When I'm going, this is like, but I started doing podcasts like 8 months ago, and I'm just like, oh my god,
Yeah. But
it's not good.
the most important part, man, the real thing behind all of the fancy fluff that you may see on social media and websites and all this stuff, it's all about the genuine results. And man, it's there no matter if it takes a couple of seconds longer to spell the name Redwood Capital Advisors or not, the results are there. So you can see it, and it's all about you and your game. That modular piece is very interesting, talking about new build, but I can definitely double down on the local engineers, local contractors. You know the ins and outs of the people from the municipality, because they can make or break your deal going through those processes, and getting you on the table, getting you in front of people is so important.
I mean, don't think you're better off going with like a fancy architect from the city, or that's expensive and has is well known. No, go with the local guy who has a home office and
Right.
and also in terms of general contractors, at least get multiple quotes, and try to have a contract in place that limits or does not allow change orders, so
Yeah.
they cannot try to rewrite the rules on you midway through.
Yep. Yep. Definitely a challenge. If you could go back 10 years, Ben, and set beside somebody maybe in the same path as you, kind of eyeballing the real estate piece kind of around you, whether coming from a hedge or in the finance world, what would you say to that person 10 years ago, knowing what you know now?
Be much more frugal. Just don't spend money on cars or watches or things that you think are important to get people to think a certain way about you. Just really be comfortable in your own skin, because at the end of the day, that stuff is worthless. And like a $10,000 Rolex, if I invested that money 10 years ago, it would be worth well over $150,000 today.
Mhm.
That's money I do not have, and I'll be the first to admit I made some stupid decisions when I was younger.
Yeah.
And obviously not I made some good ones, but if I was going to go back and give anyone advice, it would be, you don't need to drive a fancy car. The strongest man in the room is the silent man in the room, the guy driving the 10-year-old Toyota but owns 10 buildings and with no debt. That's the rich guy.
No debt, man. That just sounds good to me. No debt. I mean, we leverage debt
Or
100%,
minimal
but
debt, maybe 40%
yeah.
LTV. Who knows? You gotta have a
That
little.
way we got to give that money some velocity, buddy. Man, Ben, it's been awesome. I'm just astonished at your experience, what you've put together. That portfolio is awesome, and the diversity in it, and the idea of those motorhome parks,
The
RV
luxury RV
parks.
destinations.
Yeah,
Yeah.
that's very
That's
interesting.
really the trend. If you can, I just started. If you can find someone that is doing that in a hot area, it's just I've analyzed. You should tell, I've analyzed a lot of businesses and a lot of industries, and I've never seen a supply demand imbalance like that.
Right.
And and what's crazier is, as I said, the average age of the destinations are 40, and they're still full.
Hmm.
They're
Yep.
100% occupied. It's like nothing I've ever seen, and I did not believe it until I spent a lot of time in Mississippi and Alabama, and I had to see it with my own two eyes. But
Wow.
it's like nothing I've ever seen.
Wow. Yeah, and if you could put the system thinking, I mean, if me as like I can with a backpack, I can go anywhere in the world and do what I do. So if I can go to one of these RV parks and plug into glass and have a gym, have that fiber optic and gym, woo,
Our
sign
gyms
me
have
up.
we have Pelotons and
Yeah.
co-working spaces. I mean, and
Co-working space.
they're
Yeah.
also going to be efficient in terms of solar powered, and they have
And give
resort
me one of
style
these, a
pools.
podcast booth, huh?
Exactly.
Yeah,
And you're
man.
all set.
YouTube stream. Man, we're talking about it. That's awesome. Let's stay in touch, man. Ben, I really appreciate it. If the listeners out there want to get a hold of you, it's Redwood Capital Advisors. And just, I mean, if you've got something different outside of the box, I say reach out to Ben and put it on the table and just have a discussion with them, whether it's medical, whether it's the RV park. This high end Airbnb is very interesting, but so many pieces that will give you the experience you need, and that conversation I think is warranted. So check him out, redwoodcapitaladvisors.com. Ben, you're awesome, man. I appreciate it.
Yeah, thanks so much for having me. I really appreciate it.
Very cool. And to the listeners out there, we appreciate you and your time, and more importantly, your attention. Shoot us an email if you have any questions, if you like to be a guest, or you would like to have somebody on the show as a guest so that we can put them in a headlock and get some of that valuable information out of them. Send me an email, info@physicianwealthsystems.com. Thank you. Enjoy the rest of your day or the rest of your evening. We'll catch you on the next show.